Happy Resort Company currently has 1.2 million common shares of stock outstanding, and stock has beta of 2.2. It also has 10 million face value of bond that have 5 years remaining to maturity, an 8% coupon with semi-annual payment and a price to yield 13.65%. If Happy issues up to $2.5 million of new bond, the bond will be priced at par and will have a yield of 13.65%. If it issues bond beyond $2.5 million, the expected yield on the entire issuance will be 16%. Happy has learned that it can issue new common stock at $10 a share. The current risk-free rate of interest is 3% and expected market return is 10%. Happy's marginal tax rate is 30%. If Happy raises $7.5 million of new capital while maintaining the same debt-to-equity ratio, question is, what is weighted average cost of capital? The question is asking weighted average cost of capital to raise $7.5 million. WACC can be calculated by weight of debt multiplied by cost of debt multiplied by 1 minus t plus weight of equity multiplied by cost of equity plus weight of preferred stock multiplied by cost of preferred stock. In this question, it only accounts for weight of debt and weight of equity, cost of debt, and cost of equity. Let's figure out weight of debt and equity first. The company currently has 1.2 million shares of stock at a price of $10. So stock market value becomes $12 million. And company also has 10 million face value of bond that have 5 years remaining to maturity and 8% coupon with semi-annual payment. With this, we can figure out payment is $400,000 and period is 10 and yield is 13.65%, so required rate of return becomes 6.825%. With this information, we can calculate present value of bond using the financial calculator. So let's plug the number. $10 million future value and 0.4 million payment and period is 10 and 6.825 required rate of return, then compute present value, then present value becomes $8 million. So in total, 20 million capital, 8 million is debt, and 12 million is equity. With this, we can figure out weight of debt is 40% and weight of equity is 60%. The company wants to raise $7.5 million capital with the same capital structure. That means company is going to raise $3 million debt and 4.5 million equity. According to the question, when the company issue debt beyond 2.5 million, expected cost of debt becomes 16%. Now let's move to figure out cost of equity. Cost of equity, according to the CAPM approach, becomes risk-free rate of interest plus stock beta multiplied by expected market return minus risk-free rate of return. In the question, it said risk-free rate of return is 0.03 and stock beta is 2.2 and expected market return is 10% and risk-free rate is 0.03. We calculate this cost of equity becomes 0.184, 18.4%. Now we know the weight of debt and weight of equity and cost of debt and cost of equity. So let's plug this number into WACC formula. WACC equals 0.4 multiplied by 0.16 multiplied by 1 minus tax rate is 30% plus weight of equity 0.6 multiplied by cost of equity 0.184 becomes 0.0448 plus 0.1104 equals 0.1552, 15.5%.